Okay, guys, how's it going? Today we are going to talk about the importance of a balance sheet to lenders. It's so important that we as small business owners understand what our balance sheet looks like, not only to us, but understanding the perspective that others are going to have to it. And, by the end of this, you're going to understand exactly what lenders are looking for, okay? And so let's go now to the Excel worksheet. And I've moved away from the PDF just because in Excel, I can change the numbers and we can see the formulas, update amounts, and that sort of thing. So let's go to that. All right, so right now, when we're looking at this, all right, so one of the first things that lenders are looking at is liquidity. And liquidity is basically a word in finance that discusses, essentially cash on hand. Not exactly, but like accounts receivable can be quickly converted to cash, or it should be. Same thing with inventory. Those are a couple of other accounts that quickly can become cash. So they will look at a couple of different ratios. One of them, we've discussed both of these, and it is, it goes back to our discussion on ratios, right? The current ratio and the cash ratio, and also net working capital right here. These guys right here. Okay, so if you have a current ratio that is less than 1, and if it's less than 1, that means you've got negative net working capital. And let me show you what I mean by that. Is if this is $3,000, our cash amount is, if we only have $3,000 on hand, you can now see that our current ratio went down. All of these ratios went down. And what that means is you don't have enough to pay your current liabilities. And they want to know, the whole reason that they're going through this exercise with you is because what do you think they want, right? They don't want to give you money. They want a return on their investment. That's what the interest is. So they want to make sure that they can get paid back. All right. So let's flip that back. A current ratio of 1.5 is pretty good. It would be better if this cash ratio was bigger. But these are just a couple of the indicators that they're going to be looking at. All right. So just kind of seeing some analytics here. And this is, also one of the things, if your ratios aren't like that, what steps can we take to make that go up, right? Those are some questions that we should be asking ourselves. It's like, wait, maybe you recognize right now that your financial position is too weak to go in to get a loan. So then the next question has to become, how do I get my business to a point where I can walk into a financial institution and ask for money for a loan? All right. So the other side is really with the leverage ratios, right? They're going to be looking to see how much equity you have, because they want to make sure that you have skin in the game. All right. What do I mean by skin in the game? In this case, it's going to be equity. Okay. And in looking at this balance sheet here, all right, we're going to be, again, we're focusing here on leverage, right? Those are the numbers that we're looking at. But most importantly, it's really the debt to assets ratio and the equity to assets ratio. Okay. And I have a client that I go through this with on a regular basis. And because they were required to have debt covenant calculations on a quarterly basis. because they have a line of credit with this financial institution. And I have conversations with the lender on a pretty frequent basis. And one of the things that he's telling me is that, hey, while it's not in our debt covenant calculations, it's not in our debt agreement, we look kind of on the back end of things and say, you know what, we want the owner of this business to have at least 40% equity in the business, okay? So here's the question that we need to ask. Can I get a loan with my current balance sheet if I have to have 40% equity in the business? What do you think the answer is? It's no. Because let's think about what this looks like post-loan, okay? Let's say that now I go out and I get a $50,000 loan, okay? That means my term loan goes from 50 to 70, all right? That's an addition of $50,000, okay? So that goes way up, and our equity will be going down by the same amount. Because remember, our net assets, this all has to balance, right? So at the end of the day, now all of a sudden I have negative equity. And actually, Chloe, I'm going to go back and I'm going to redo that section, okay? Yeah. Because I said this incorrectly. I did that totally wrong. So let me redo that. So the question now becomes, if 40% equity is one of the things that our lender is looking at, are we going to be in a position to get a loan? So let's tweak some of this a little. Let's see what our business looks like if we assume that we're going to get a loan, right? So we're going to get, let's say we are trying to get $50,000 of new lending, meaning this amount goes from $20,000 to $70,000. And the proceeds of that means that's going to go straight into our cash account. Okay, so that goes to 70. All right. So look at what that does to our equity to assets ratio. It went from 40% to 27%. The point being is, if they're expecting you to have 40% in the business and you borrow more, the only thing that can happen is that your skin in the game goes down. Okay, it goes down. And that's why it's important to be able to manage your balance sheet in such a way that you can be prepared for a loan if you ever need it. Does that make sense? So those are just, we're really kind of focused on the balance sheet side of it. There is a whole nother thing, and we'll cover this in the next series, where we're talking about what they're looking for on the income statement side. But these are the main things that they're looking at. The other one is they're wanting to know how much debt you have as well, right? So the percentage of debt went from 60% to 73%. Your equity went from 40% to 27%. So now, what does that mean? Right? And it means two things. It means that while they're not an official owner of your business, they own a lot more of your business now than you do. And you own a lot less. Okay? So those are just some of the things that you need to think about. And that's where the debt to equity ratio comes in. Your debt to equity ratio is now such that there is 275% more debt than there is equity. That's what that ratio right there means. This one, let me highlight it, okay? Because this one can be a little harder to understand. You know, this equaling 1 all the time, this will always equal 1. This one doesn't. So it's a little bit of a trickier number to understand. But that's what that means, that you have 275% more in debt than you do equity. All right. So that's that one. So that's a wrap on this one. Next week, we're going to talk a little bit more about how you as a small business owner should be looking at this. We talked about how the lender looks at it, but let's talk a little bit about how you should be looking at it. And I'm gonna kind of walk you through how I look at my own financial statements. And then, because I think that listen, I'm a small business owner just like you are. And I want to really teach you guys how to use your financial statements for the good of your business, right? That's what this is all about. So if you have questions about anything that we talked about in this video, drop them in the comments. If you have something that you want me to cover in a future video, drop that in the comments. I promise that I will put it out here eventually. And don't forget to follow our page.